I'm Daren Chamblee, a certified financial planner, and today we're going to look at the new tax landscape of 2026. We're going to move past the headlines and look at the actual math that affects your retirement accounts, your home, and your legacy. We're going to make sure your strategy is updated so you can truly put your retirement on cruise control. Let me tell you about a couple, and I'm going to call them Dave and Barb. They're retired, living here in Tennessee, and they have a beautiful home, with property taxes that had been capped at that old $10,000 limit for years. They were also right in that sweet spot for the new senior bonus. Their total income from Social Security and some modest IRA withdrawals was right around $145,000. Now, David wanted to take $20,000 out of his traditional IRA to do some landscaping and put in a new patio. He figured his taxes wouldn't change much because the rates were made permanent. But when he sat down, we realized he was about to hit the double whammy. For the last several years, every headline has been screaming about the 2026 tax cliff. We were told on January 1st, the clock would strike midnight, the old tax rates would come rushing back in, and your tax bill would skyrocket. But now that we're actually here in 2026, the reality looks a little bit different than the hype. We didn't fall off a cliff, but we did land on a brand new map, and if you're still using last year's playbook, you're going to get lost. Now, when the One Big Beautiful Bill Act, or what many are calling the Working Families Tax Cut, passed, it completely rewrote the rules for retirees. It saved us from the higher tax rates we dreaded, and it replaced them with a series of new deductions and phase-outs that are specifically designed for high net worth families. If you don't understand where you are on the new map, you could end up paying more taxes simply because you didn't know which boxes to check. Let's cover 3 major shifts in the 2026 tax code. First, let's look at the permanent extension of the current tax rates and a massive increase in the standard deduction. Second, we'll break down the new SALT cap, which has jumped from $10,000 to $40,000. It's a game changer for homeowners in high tax areas. And third, we're exposing the senior bonus trap, that brand new $6,000 deduction that sounds great until you realize how easy it can be taken away from you. So let's start with the good news. The tax brackets we've grown accustomed to, 12, 22, 24% rates, are now permanent. We're no longer facing a jump back to the old 15 or 28% rates. And on top of that, the standard deduction has been boosted again. For 2026, a married couple can shield $32,200 from taxes before they even start counting their income. For most retirees, this means a significant portion of your basic living expenses. It's now essentially tax-free. But the real headline for 2026 is the SALT deduction. For many years, one of the biggest complaints I heard from clients was the $10,000 cap on state and local taxes. If you had a nice home and a decent income, you were likely paying way more than $10,000 in property and state taxes, but you couldn't deduct a penny over that limit. Now in 2026, that cap has been raised to $40,000, and this means families who took the standard deduction for the last few years might actually find it more beneficial to itemize again. If your property taxes and charitable giving add up to more than $32,000, you could see a massive drop in your federal tax bill by making that one simple switch on your return. Now let's talk about the brand new senior bonus deduction. This was supposed to be the centerpiece of the 2025 legislation. If you're 65 or older, you're now eligible for an additional $6,000 deduction or $12,000 for a couple, on top of your regular standard deduction. It's a direct thank you to the millionaire next door generation. However, it comes with a very sharp cliff of its own. This deduction begins to phase out once your income hits $75,000 as a single person or $150,000 for a married couple. This is where the new 2026 strategy comes in. If you're right on the edge of that $150,000 line, making one extra withdrawal from your IRA to buy a new car or help a grandchild with college could cost you much more than just the tax on that withdrawal. It could trigger the phase out of your senior bonus, effectively taxing that money at a much higher rate. Now in 2026, Bracket management is no longer just about staying in the 22% range, it's about guarding these new deductions. Now, let me tell you what happened with David and Barb. Remember, David wanted to take $20,000 out of his IRA to fix up his yard and patio, but he was about to be penalized. First, that $20,000 in extra income would push them over the $150,000 threshold, causing them to lose a huge chunk of their $12,000 senior bonus. Second, because their property taxes and charitable gifts were already high, they were actually better off itemizing under the new $40,000 SALT cap, but only if they kept their income lower to avoid certain phase-outs. By adjusting their plan and taking $10,000 from David's IRA and $10,000 from their tax-free Roth account, we kept them under the phase-out line. They kept their full $12,000 senior bonus. They utilized the new higher SALT tax deduction to lower their taxable income even further. And they got the new patio they wanted. They saved nearly $4,000 in taxes just by knowing how to navigate the new 2026 tax map. To recap, 3 things you need to focus on this year. First, stop worrying about the old 2026 tax cliff headlines. The 12, 22, and 24% brackets are here to stay, so you can plan your Roth conversions and income strategy with much more confidence. You're not going to fall off a cliff, you're just on a new map. Second, reevaluate your deductions. With the SALT cap now at $40,000, you need to check if itemizing is back on the table for you. It could save you thousands if you have high property taxes or give heavily to charity. And third, guard your senior bonus. If you're over 65, that $6,000 to $12,000 deduction is yours to keep, but only if you keep your income below those $75,000 and $150,000 phase-out lines. The tax world didn't end in 2026, but it did get a lot more interesting. The opportunities for high net worth families to save money are better than they've been in a decade, but you have to be intentional. You can't just set your plan and forget it. If you're looking at your 2026 income and you're not sure if you're hitting these new phase-outs or if you should be itemizing under the new SALT rules, don't leave it to your tax preparer to figure out next April. By then, it's too late to change anything. Click on the link in the description below to schedule a time to talk. As a financial advisor, it's a key part of how I help clients, making sure you aren't leaving your hard-earned money on the table. And if you like this video, I think you'll also like this one right here. I'm Daren Chamblee, and let's put your retirement on cruise control.